that in a lot of markets around the United States, food prices are up as high as 25%.
Are you prepared for it? And the better question is, how do you prepare for it, and how do we get through? How do you get through what's about to happen? Because it's one thing to crash, but can you survive it?
It's time to start paying attention and taking control, because exactly what you just said, right? If we thought consumer inflation has been bad and caused, disgruntled civil unrest, just wait until we see food and fuel riots in the streets. And I've never been a doom and gloom guy. It's our job to find our angle, right? Not get wrapped up in the hyperbole. I'm an investor, I'm looking to make money. But this is, I think the rest of the 2020s will be like the first 2 years of the 2020s, right? Unprecedented is the new precedented. And this is just getting started.
From an economic standpoint, I think the biggest question is, do we have deflation or inflation? And that's kind of the debate going back and forth. And for the average person, I think they just have to look at the entire economy as supply and demand. So the supply is how much stuff do we produce? How much goods and services? Demand is how much money we have, or our willingness or our access to credit to go out and buy the stuff.
So the way you predict the future, you've got to watch the cash flowing. And that's why what Kim says, most people have no idea what that word means. It's going out. So financial intelligence or financial IQ is, can you turn your cash flow back into you? And because most people have no financial education, their cash keeps flowing out. Number one is taxes. Number two is they buy that house they call an asset, but it's actually cash flowing out to the bank. And we're in the biggest bubble of all time. Stocks, bonds, mutual funds, real estate, biggest bubble. To me, the best investment is still silver, gold, and oil, and Bitcoin or crypto.
Yeah, and so where I'm looking right now is junior mining equities. I'm heavyweight. Gold and silver, I'm quite exposed to Bitcoin, and I feel like that's my insurance policy. That's the moat, right? And there, if you've got a great moat, how do you build a castle? You look for the upside.
Gold, oil, and silver are real money. Not the dollar, not the loonie, not the Canadian dollar, not the peso, not the yuan, not the US dollar. Its resources are real money. I want resources. I want gold, silver, oil. That's what, and today, Bitcoin.
When this bubble did blow up, I expected that it would blow up. It did blow up, but I expected when it blew up that there would be a depression. But what we saw instead was the US government borrowed trillions and trillions and trillions of dollars and pumped it into the economy. And the Fed created $3.6 trillion during the first 3 rounds of quantitative easing and bought those government bonds, financing that government debt. If the Fed had not bought those bonds, if the Fed hadn't created all that money, the government couldn't have borrowed so much money without pushing interest rates to an extremely high level. All of that government borrowing would have pushed interest rates up, and the very high interest rates would have crushed the economy and done even more harm than the government spending did good supporting the economy. And so this combination of trillions of dollars of government borrowing and spending and trillions of dollars of money creation by the Fed to finance the government spending, they reflated the bubble. The bubble didn't implode. It just got bigger.
Thank you, Jesus.
And then it's been an exact replay of that again in 2020 and 2021. For instance, in the last 2 years, 2020 and 21, because of COVID, the economy started to collapse again. And in those 2 years, the government has borrowed $6.3 trillion, increasing government debt by 27% in 2 years. And the Fed has created $4.6 trillion to finance that government debt. In other words, by creating this money, the government's financed 73% of all the money that the government has borrowed, the Fed has. And so that's allowed the government to borrow $6.3 trillion, and interest rates didn't go up, they went down. Interest rates are still extremely low. So this has created a big boom in asset prices. Stock markets went to record highs, property prices went to record highs, all kinds of wild asset classes went to record highs. So they kept the economy from collapsing again. in the same way this time as they did in 2008. The Fed was still creating $120 billion every month. And then in November, they said they were going to start tapering that, reducing that by $15 billion a month. But the very next month in December, they said they're going to double that and reduce it by $30 billion a month. And that meant that it's going to come to a complete stop early. The money printing is going to end totally early next month. No more printing. And then the real blow came because in early January, they started letting it be known that they were planning to do the opposite. Instead of printing a lot of money through quantitative easing, they're going to start destroying a lot of money through quantitative tightening. Now, when they print money, that pushes asset prices up. When they destroy money, that tends to make asset prices fall. Well, they destroy money because when they print money, they buy bonds with that money. And normally, when the bonds mature, they just roll them over and buy a similar kind of bond. But they destroy money by essentially selling those bonds. And when the Fed, what happens is the bonds mature and the Fed doesn't roll them over. Someone else has to buy the bond. So the Fed gets its money back. And when the Fed gets money back, that money just evaporates. The Fed doesn't need to keep any money because it can make all the money it wants anytime it wants to. So it's a bit complicated to explain in just a few sentences, but the bottom line is it's the opposite of quantitative easing. Quantitative tightening destroys money, and that tends to make stock prices fall. And we're about to get a heavy dose of quantitative tightening coming into effect within the next couple of months.
There's a lot less of the goods and services that are actually being purchased, right? So that decreases the demand equation. That's what most people get fixated on. So they think, okay, well, we have to have prices going down, deflation. But they forget about the supply side of the equation, because if the people can't go out to produce goods and services, well, the supply will go down fast as well. So then the question becomes, what's going down faster, demand or supply? Well, then you look at the supply chains that have been disrupted coming into the United States. If you go to Walmart, Target, Home Depot, the majority of the stuff you see on the shelves was produced outside of the United States. So if those supply chains get disrupted, that means less supply. Then what happens is, usually going back to Dalio's example of long-term debt cycles, you get social unrest. And I hate to say that, but that's just the reality of the situation if you look at history. And typically the way the politicians take care of social unrest is through helicopter money. So whether you want to call it MMT, UBI, it doesn't matter. It's basically the government spending money into the real economy, getting into the back pockets of the average Joe and Jane. We could see a situation in the future where the Fed is actually doing it. They're not technically allowed to do it right now, but they've been breaking all of the rules. So if there's more money in the pocket of the average person, that means there's more demand, even though they're sitting at home not going to work, for those goods and services in the economy that don't require debt. That's key, because people see deflation and inflation as just this, it's binary, right? It's either one or the other, but it's actually very nuanced. So if there's less debt in the system, that means asset prices could go down, or cars, anything that most people buy using debt, okay, the prices of those go down. But anything people buy, or most goods and services people buy on a daily basis that don't require debt, such as groceries, those prices typically go up. In a lot of markets around the United States, food prices are up as high as 25%.